Hello and welcome back. Today we're starting the last part of the course. So far we covered the external environment, the industry environment. We looked at the resources and capabilities of the firm. We spent quite some time talking about business level strategies which describe how the firm competes in a specific product market. And we also looked at how those strategies depend on the kind of industrial environment that you're in, right? How fast the environment is growing, whether or not it's technologically advanced, whether it's entering the maturity stage or the decline stage. So today we'll look at corporate level strategies. And corporate level strategy primarily answers the question which markets we compete in, right? So not how we compete, but where we compete. And that is a pretty important topic as well. So I encourage you to pay attention. I will be covering some issues that are not included in the chapter. So I hope that you guys can take away something from it. I think that would be helpful and beneficial. In terms of the lecture highlights, I'll provide an overview of corporate strategies and I'll talk about why companies do that, not all the reasons for them to consider multiple industries, multiple markets are good. And the textbook is not very precise on that, so I will spend a few minutes there. I'll talk about vertical scope and product scope as pertain to corporate level strategies. There's another one that has to do with geographical scope and international strategies, but this we will cover next week. And we'll talk in more detail about diversification and the way it can help us with competitive advantage above average returns. And then we'll talk about how specifically the firm can manage its scope, because there are multiple ways, and some of them are fairly hands-off and arm's length. So we'll need to look at that as well. So with that, let me move on to the formal definition of corporate level strategy. And so basically, that's the strategy that is primarily concerned with the scope of the firm. And when we talk about the scope, we distinguish between vertical scope or vertical integration, product scope, this is known as diversification, and geographical scope, primarily internationalization. I guess in some cases, if you're dealing with a country as big as the United States, we may think about corporate level strategy and managing geographical scope as pertains to maybe activities across different states, especially if you consider such remote states as Alaska or Hawaii or something like that. But primarily geographical scope has to do with internationalization. There are multiple reasons for why firms engage in managing their scope. So previously we talked about managing scale, and you remember that managing scale results primarily in one of the two possible business level strategies, cost leadership and differentiation. So here we have three groups of reasons why companies may decide to operate in more than one industry. Some of those reasons are value creating. Here we may talk about, maybe the company has exhausted opportunities for growth in its industry, and if it is to continue growth, it has to go someplace else. So you think about Starbucks, and it has really been extremely successful and spreading across the United States and around the world with its original industrial offering. But at some point, I don't know if you guys remember that or not, you travel on a highway, you take an exit, you come to a plaza, there'll be two Starbucks places competing against each other, right? So it exhausted the opportunities for growth. If it wanted to do something else meaningfully, it had to consider diversifications, and that's why you started seeing the company entering into those bottled frappuccino drinks and adding teas and more dining options to what it was offering. So that definitely explains why the company was considering going outside of its narrowly defined industrial area that was initially pursuing. Some of the reasons for managing the scope, for increasing the scope of the firm, may be value neutral. It could be that maybe there's some sort of government regulation that makes you expand, right? That makes you go outside of your industry. It could be concerns of your monopolistic power. It could be any number of things, but sometimes you're just forced to do it. Sometimes you are encouraged to go into other industries because your shareholders tell you to, not because they believe that there is some unique value that you would be able to reap if you go into a different industry or a different market, but simply because your rivals do that, and this is the sort of an organizational mimicry. You have to imitate what your competitors are doing, because they cannot all of them be wrong, right? If everybody else is doing it, you have to match. So even though there may not be a true strategic reason for you to consider it, you may be forced to go into other industries or other markets, other geographies, just because. And then finally, what we typically do not really like talking about, but something that you have to keep in mind as you build your own careers, sometimes increasing the scope of the firm is actually governed by value reducing reasons. And so ultimately, the decisions to go into different industries, it would be pushed for by the top management of the firm. And they have other reasons than increasing shareholder wealth to consider such sort of strategic moves. One of them is diversifying managerial employment risk. If you operate in multiple industries or multiple markets, it is entirely possible that some of those will be doing quite well, despite of what you do, while others may be experiencing some sort of financial trouble or economic trouble. In that case, it is much harder for shareholders to assess your effectiveness as a strategic manager, right? So if your company is present in multiple industries, if overall your performance is sort of okay, even though some of them perform much better than others, then your employment risks are not quite as great. The other reason why managers may push too much towards expanding into other industries has to do with managerial compensation. The trick here is that the larger the firm, the more complex its operations, the higher the compensation that top managers may expect. Why is it? So obviously, if you know how compensation is structured and set for top managers at public firms, typically there's a board of directors, there's a compensation committee. They look at how other managers at similar firms are compensated. And it's just the, just the fact of nature that managers at diversified companies tend to get higher compensation, higher perks, higher status. So if you happen to be governing a larger company, diversified company, you sort of have to match what the rivals are doing. So managers obviously have all their own incentives to push towards extending the scope of the firm, because that will necessarily drive up their own compensation, wealth, status, perks, business jets, and whatever the case might be. And ideally, if you expand into other industries, right? If you manage your vertical scope appropriately, you should expect significant cost savings, and we'll definitely talk about those in a few minutes. But you have to remember that ultimately all the benefits that you can reap from from increasing the scope of the company are kind of counterbalanced by the costs. There are different kind of costs, and we'll discuss those as well. So keep in mind that this is not a all or nothing proposition. It is always a matter of careful balance, and I hope that today we'll be able to discuss at least some of the tactics or strategies at finding the proper balance. All right. So, how do companies manage their scope? In the most basic way, there are three options that they have available. One is if they decide to operate in more than one industry or maybe more than one geographic market, they can try to do it organically. They can try to go for the internal development of a new product, new market, whatever the case might be. It usually takes a long time. If the industry they target is sufficiently different from the one where they currently operate, they may not have the required capabilities to do a good job fast. And this is something that you need to be aware of. So even though some companies do prefer to grow organically, for many of them, this is not a decent proposition. So they want to be careful with that. And for that reason, the vast majority of them, at least historically, would consider managing their scope through mergers and acquisitions, right? So this is where they acquire companies that already operate in the industries that are of interest to the focal company, right? There are multiple ways that can be arranged. Again, there are differences between mergers as such and acquisitions or takeovers. So we'll probably mention those later on today. But that is the sort of the next logical option that companies have. And up until recently, many of them were really preferring growth through merger and acquisition. There is another option that we do not necessarily think about too much, and that option involves collaboration. So rather than acquiring a company that operates in a different industry or a different market, you can try to build a collaborative relationship of some sort. It could be a strategic alliance, it could be joint venture, it could actually be a multi-partner network where you connect many companies that stand to gain from such collaboration. And we'll talk about that as well. This potentially can give you all the benefits of having a larger scope without necessarily the costs being there. So we'll identify that later on. But we're going to start with vertical integration, right? So I said that companies have to manage the vertical scope, the product scope, and geographical scope. So vertical integration is the first of these three. And basically it refers to the firm's ownership of multiple vertical stages in the supply chain of the program. What does it mean precisely? Right? A lot of companies are concerned with, sort of one tiny little thing, one specific product, one specific maybe group of products, or one specific customer that they serve, and they may choose to integrate along the value chain backwards or forward. What does backward vertical integration means? It's when the company um, acquires essentially its supplier. So if you happen to be, again, as the textbook says, maybe manufacturing cans for drinks, you may actually acquire a company that makes aluminum. Whether or not it's justified is a big question in this specific example, but that's what we talk about. At the same time, you may choose to acquire a beverage manufacturer so that all the cans that you produce will be used in your own facility. So those are the kind of things that the notion of vertical integration deals with, right? It's how vertical integrated you are, how many stages of the supply chain you really control. So it has multiple benefits, right? The idea of vertical integration. In many cases, in many industries, it actually is economically sound to co-locate those different stages of the production process. If you make in metal, if you, I don't know, you got iron ore, you melted it, you got the steel. It probably doesn't make much sense to cool it off, to cut it into chunks, and then haul it across the country to a place where it can be transformed into steel sheets, right? So in many cases, co-location is economically justifiable. And once those assets are co-located, why not co-own them so that there is no uncertainty as to who buys what from whom and at what price? So technical economies are definitely the case for many industries. And for that reason, at least some chunks of the industry-specific value chain are naturally integrated. The other reason why vertical integration could make sense is that unless you're integrated, you may have to deal with different parties all the time, buying your supply sometimes here, sometimes there, negotiating contracts, dealing with unique maybe supply chains, transportation, logistics, selling your things to different companies, right? So very few companies actually sell to individual users. Most companies would sell to other businesses. Uh, some of them at the very end of the value chain will deal with individuals. So probably the number of your customers is kind of limited. And if you don't have strong vertical relationship, you probably need to renegotiate the terms of the trade all the time. There may be some disputes that you have to deal with. There may be legal issues that you have to address. So, and all of those obviously come at a cost. So if you vertically integrate, if you control all those stages of the value chain, maybe you're saving money. Maybe you increasing the speed with which your manufacturing happens or dealing with customers happens. So there are definitely benefits. At the same time, there are multiple problems with vertical integration. First of all, and this is really essential, the optimal scale at different stages of production may not match perfectly. Again, I would probably refer to the example that your textbook provides. If you are a beverage manufacturer and you want to make your own cans or bottles, to break even, to reach that optimal scale at which making your own cans or bottles makes sense, you have to produce so much that your beverage department or beverage facility will probably not be able to satisfy, to consume all the bottles that you create, right? All the cans. So rather than having this integrated business where every part is working together nicely, you would probably still be in two separate businesses because in addition to supply your own downstream unit with whatever it is that you make, you'd have to sell the excess units of the whatever it is that you produce on the market to break even, to make sure that your upstream facility operates at its optimal capacity. So it's hard. And earlier in the 20th century, this whole drive towards vertical integration was particularly strong. I want to say that at some point, Ford Motor Company actually owned its own iron ore mines because they believed they needed to control everything to ensure quality, to maybe make all the money that could be made across every step of the value chain. Right now, you see much less of it. And ultimately, if this whole idea of vertical integration was so powerful, then really the Soviet Union should not have failed. Because there, everything was owned by just one mega owner, the government, or technically the people, right? But as we all have seen, that ownership and ultimate integration did not result in kind of efficiency that you could have expected, right? So this optimal scale and different costs associated in managing vertically integrated entities, they are a very serious impediment to how far you can grow your business by integrating it along the value chain continuum. The other thing that is kind of costly when it comes to vertical integration, you need to develop distinctive capabilities, right? If you manage businesses across multiple industries, across multiple markets, you have to keep investing in whatever makes this business or that business successful. And as you remember, when we talked about capabilities and competences, we said that companies are actually limited in how many of their capabilities could be core competencies. It is not feasible to expect that any single company will have 10 of core competencies. Usually the number is limited to 2 or 3. Now, if you are an integrated company, those core competencies that you have could be particularly effective for some parts of the value chain, but could do very little to succeed in others where different competencies are required. So it's simply not feasible to expect a company to be equally competent across all the stages. And for that reason, competitively, it's probably not a very good proposition to try to excel at everything. Managing strategically different businesses is complicated. Again, they may have different operation cycle, financial requirements, competitive environment, right? Industry attractiveness, all of that could be different. You try to bring this all under the same umbrella. Your attention span, your mental capabilities are limited, right? So we talked about bounded rationality. Because of this bounded rationality, it's not possible, or at least not plausible, to manage that very effectively. Once you bring the company along the value chain under your corporate umbrella, it no longer has to be, the best, the most efficient. The nature of incentives changes. When you source your inputs from multiple suppliers, or when you sell your products to multiple buyers, there are very strong, powerful incentives for every piece of that value chain to do their best job. Once that pressure is removed, people relax. People don't necessarily do their best job. And sometimes you can exploit whatever pressures exist upstream or downstream. You can buy products at below their market cost. Once you control that other business, this is no longer an option. You will be absorbing the losses that otherwise would have stayed with an independent company, right? So it's a bit tricky. You also engage in competition with so let's say if you backward integrate into the industry of your supplier, all of a sudden you start competing with all other firms that operate in the same industry. So previously they were competing for your attention, they were competing for your orders. Now you compete with them directly. The same happens with buyers, right? So that generates a lot of complicated dynamics in the industry, so not necessarily helpful. You definitely lose your flexibility, and you may accidentally or for whatever reasons invest in an unattractive business, right? The business that maybe operates in an unattractive industry, or the business that, because it's in a different industry, you are not able to assess, evaluate properly, and so you have no idea what you're getting into. So you may end up stuck with a lemon. So fundamentally, this vertical integration dilemma boils down to the decision of make versus buy. And your textbook provides a rather detailed set of characteristics of vertical relationships and implications for strategy business, conditions which make vertical integration more or less likely. I will not go into those here, and I definitely suggest that you guys go there and spend a few minutes reading through those. Now, in terms of vertical relationships themselves, They are not all of them created equal, right? So they definitely differ by the degree of commitment of partners to the relationship and by the degree of formalization. So they may be, in some cases, yes, you do buy a supplier or buyer, and this is how you become vertically integrated. You may also have relationships such as franchising or joint ventures or long-term contracts, which imply a much different kind of the formalization and commitment between the parties. So we'll talk a bit about joint venture strategic alliances later on today, but the whole idea is that you can manage vertical relationship without necessarily committing to that partner 100% long term in the most formal way. Right, so I will just leave it here. We would probably come back to some of these issues. If not, again, the textbook does provide some details. So I encourage you to get familiar with that. So that was vertical integration. Um, the other dimension where you can manage the scope of the firm has to do with product scope, right? And here we talk about diversification. You do not want to keep all your eggs in the same basket. You want to go into multiple markets. You can go to different industries. And all those diversification efforts, they do have a different rationale, different motives, right? So again, sometimes you have exhausted the opportunities for growth in your own industry or in your own market. So you have to expand. You have to go elsewhere. And hopefully you'll find a place, you'll find an industry where your capabilities could be of value and you'll be able to benefit directly from them in this new environment. You may also choose to diversify to reduce the risks. Let me give you a very simple example. Um, you probably all have seen, had some experience with heating, ventilation, and AC businesses. So obviously heaters and ACs, they're very different technologies, they do very different things. Why is it that the same company typically operates in those two very different markets? Well, the answer is very simple. It's all about seasonality. Um, Obviously, heating and ventilation is of primary importance to people, to customers in the winter season, whereas AC is mostly in demand during summer. So by committing to both of those, by diversifying into these, um, you're kind of safe against the seasonal dynamics. You may also diversify to reduce the risk of economic cycles, because different industries are at different stages of the economic cycle. If you diversify, if you go into multiple industries, you are protected, or so you hope, against simultaneous decline in multiple industries. And this is what I referred to when I said why managers like so much to diversify is that on average, they would be doing just fine. Maybe not because of what they do or because of what they not do, but just because, the cyclical nature of businesses, of industries will differ enough for them to enjoy the benefits of diversification. Companies also diversify because they believe they can create shareholder value. And there are three tests that could be employed here: the so-called attractiveness test, the cost of entry test, and the better off test, that kind of tell us whether or not you should consider diversification. I will probably go in the opposite order discussing those tests. The better off test basically asks a very simple question. Will your business be better off if you diversify, or let me put it this way, will there be some unique value created from your diversifying into an alternative business? If the answer is no, if there is nothing of value that you bring in to this newly created business or newly acquired business by diversifying, then probably you shouldn't do that. So you only want to expand into other industries or other markets if there are some synergies that you create, right? So think about cable companies, right? The internet providers, they provide cable TV. They also offer phone service over the cable, although I believe this is not really going anywhere of late, as most of us are now using just cell phones. Definitely for those companies, diversifying into these three distinct industries makes a lot of sense, right? They can reuse the same infrastructure, the same cable to deliver unique products across these industries. So on top of that, they have access to your customer information. They can offer you bundles that potentially save you money, although I'm deeply skeptical of that specific bundling effort. So you would be better off function across multiple industries in this specific case, which means, yes, you have to diversify. Well, it's a good idea to diversify. At the same time, um, often, I would even say typically, when existing companies diversify, they don't do it organically. They would not necessarily build a new division from scratch, but they would try to acquire a company that already operates there, hoping that those synergies that will be created will justify the cost of entry. Well, here's the problem. Typically, when you try to acquire a company that would be specifically attractive to you for acquisition to diversify, that other company is not exactly stupid. It understands the value it creates for you, so the price it will charge will reflect those future savings or future growth and revenues that you expect. So all the benefits that you expect from diversification would probably be nullified by the premium you're going to pay for the acquisition. So this cost of entry test, you definitely have to take that into account because it is quite plausible that you're too optimistic when assessing diversification benefits. You may end up paying too much. You may actually lose money on your diversification. And so overall, the attractiveness test, yeah, you have to just assess whether or not you have what it takes to succeed in that industry, whether you'd be able to develop the necessary capabilities, um, and that's that. Does diversification lead to competitive advantage? It does in a number of cases, and there are multiple mechanisms that could be employed here. The first one is so-called economies of scope. So you remember previously we discussed economies of scale, where the basic idea was that you double your output volume and your cost per unit of production go down 20 to 30%. Economies of scope is a very similar thing, except you do not necessarily double your original output, but because your overall output increases, as long as you can share resources or capabilities across those different units that you now control, the cost per unit will go down. So again, that happens primarily if you can share resources and capabilities across the businesses that you now control. So we may talk about tangible resources. Uh, if you guys remember, I told you that Trader Joe's and what was it, Aldi, um, they are controlled by the same group of investors. And well, in fact, you guys have read the case that talks about it. So a big chunk of success in this case is their ability to utilize the same logistic capability, right? The same trucks or infrastructure, if you will, to ensure success of both businesses. So I want to say it very carefully, but I do believe that some 10 years ago, 10 years ago, so you could buy very similar products at Aldi compared to Trader Joe's. They were not packaged the same, but the quality, the manufacturer were actually very similar. So that gives you an opportunity to share resources across different businesses. So overall effectiveness and efficiency definitely goes up. In terms of intangible resources, right? It could be anything like sharing technology, which then would be very similar to sharing tangible resources, to just sharing brands, right? Brands do have value, and if you can project the strength of your brand into this new kind of business that you're entering, that will be beneficial. That will enable you to get price premiums that will contribute to the overall success of your company. And then organizational capabilities. Sometimes you may diversify into rather different kind of industries and to reuse the same capabilities you have built initially over the years, thus strengthening the position of those new businesses and reaping the benefits that come with it. You have probably heard about the company Tyco, which was engaged in quite powerful corporate scandal some years ago. That company had a very unique corporate level strategy. So the guy in charge of the company, a certain Dennis Kozlowski, he came with an MBA from a no-name school. He realized that there were a lot of people in his shoes, effectively, that wanted to prove themselves. So his entire labor, not entire labor force, but the major chunk of his labor force consisted of people who were similar to him. They were very hungry and ruthless when it came to ensure business success, because then it would reflect positively on them. It will enable successful careers for them. So they would strategically analyze many companies across different industries to find those that, in their words, were fat, dumb, and happy. They will acquire those companies and they will try to turn them around, restructure them, make them more effective, more efficient, and then would either keep them or sell them off with a substantial markup, right? So that capability of identifying undervalued companies on the market, taking them over, restructuring the top management team, restructuring the size, the scale and scope of those firms, that was the capability that was creating the benefits and competitive advantage for Tyco as a diversified company. The other reason why you may want to consider diversification is market power, right? So even if you do not acquire your competitor, right, which would be then horizontal acquisition, which again we'll mention in a few minutes, even if you diversify into related or even unrelated industries, it may help you block your competitors through multi-point competition. So if you remember that example of Intel and AMD competing in the market for 64-bit processors, for the first time in history, AMD was beating Intel at its own game. The only way Intel was able to counteract what AMD was doing is to attack AMD in the flash memory market, where AMD was sourcing about 50% of its revenues to then later on funnel into the development of new processors. Had Intel not been diversified, it probably would have lost that market, or would have lost a substantial chunk of that market to AMD. Because it was diversified, it was able to block the competitor through a multi-point competition. Companies do that all the time, right? So it is rather costly to diversified companies to attack each other. So in many cases, they choose to leave and let leave, which is beneficial to all of them in the long run. maybe not so much to us, the consumers, but to companies, definitely. You may get your competitive advantage through economies from internalizing transactions, right? Again, you don't need to renegotiate, redraft the contracts. There's no legal compliance. There are many savings that come with diversification and sort of vertical control and same ownership. Parenting advantage, that was the first time I read about it in this textbook. Basically saying that you only get competitive advantage if you are the best possible parent for the company that you intend to buy in that industry you intend to diversify. If someone else is better positioned to keep that company, to own that company, then maybe what you should do is you should sell the company to the best possible parent, obviously with the price taken into account the kind of value that this business will create for the potential buyer. And the other way that diversification and enhancing the scope of the company can create value and competitive advantage for you is a diversified firm could act as an internal market. As a big company with cash flows coming from different industries and subject to different industry dynamics, planning horizons, and whatnot, they could be an effective internal capital markets, right? You can use the profits you get from one business to develop new products in a different business. And you are actually well positioned to only fund good products because you have the ultimate knowledge of that. So, if you think that those profits from a successful business could better be invested elsewhere, you'll never have such good information on this some other project run by someone else as you would on a project that is run by your internal company, right? So in terms of the information asymmetries, you are well positioned to benefit from it. And at the same time, you may say that, okay, this company may simply put the money as a deposit in a bank and then, get some benefits from that. Well, you know that there is a gap between the rates you get for your deposits and the borrowed funds. So financially, that would not make much sense because of those transaction costs again, right? So here you kind of economize on that. Finally, the reason it's helpful is diversified firms could act as an effective internal labor markets. You identify best qualified employees, you give them opportunities to growth, you transfer them between different elements of your business and maybe sometimes between different geographies. So I know some of you work for multinational companies and you would be excited to consider international relocation, maybe try out the expat life for a while. Well, guess what? Not only is it attractive to you, it is also attractive for the company because the company is receiving an opportunity to develop you throughout the process, right? To give you the tools that otherwise you would not have had and to utilize that expertise where and when required in the company. So it's definitely a win-win if your company can provide this internal labor market, right? The company will be more attractive to you and you will develop capabilities and competencies that will make you more attractive to the company. So that is kind of interesting. That said, what do we know about diversification and firm performance, right? So we have said that there are all those reasons why diversification may be a good idea. It turns out that on average, diversified companies do not really perform that well. And more often than not, diversification does not create any value for the shareholders. So overall, performance of diversified firms is underwhelming, to say the least. There are two specific instances or two diversification configurations where value seems to be created. And in both of those cases, the diversification has to be into industries that are related or linked somehow to your current business, right? So the two strategies that makes most sense are related constrained diversification and related linked. In related constrained diversification, so first of all, you are not overly reliant on any given business that you have. So less than 70% of your revenues come from just one business. But those businesses where you operate, they do share resources, capabilities, competencies directly, right? So think about, again, cable companies sharing the cable, right? The physical infrastructure um, with its internet service, cable TV, and phones. So that would probably be the example. The second best strategy is the so-called related linked. So here there is some relation, although you do not necessarily share the same resources, capabilities, and competencies, or at least not, definitely not, but not physical resources. We can maybe move people around who have managerial know-how, but again, not the physical equipment, not logistics, nothing of that nature. Everything else is not so good. So if you consider unrelated diversification, the so-called conglomerates, that is a bad idea. So that is something you definitely do not want to do. There's enough evidence there that says you shouldn't consider it. So this relatedness that you want to pay attention to, it comes in two forms. One is operational, the other one is strategic. So operational relatedness concerns the technologies and markets. Right? So think about Starbucks diversifying into those bottled drinks, the frappuccinos. First of all, it didn't do it on its own. Initially, it partnered up with Pepsi. So Pepsi knew nothing about coffee. Starbucks knew nothing about bottled drinks at the time, but both of them could leverage their market capabilities and some of their technological capabilities to create this new product. And as a result, it was quite successful. So both companies definitely benefited from that. Apart from operational relatedness, you may talk about strategic relatedness, right? So things like management capabilities, resource allocation processes, strategy formulation, performance management, those things matter as well. And the textbook actually provides a rather detailed notion of the determinants of strategic similarity, which is what relatedness is all about. So you could expect some benefits to accrue to the firm if when you diversify, you look at investment projects of similar sizes. So you've managed that previously. You probably know how to do that again. Similar time spans, right? If you use the projects that take about 2 years to complete, you do not necessarily want to go into a business where investment projects are, 10-year, have 10-year horizon. That is something where you don't have the know-how. Where it's similar sources of risk, so that you understand those sources and can hedge against them. And obviously where similar general management skills would be required for business unit managers. So you can share your human resources, you can send people around, you can benefit from the expertise embedded in your employees directly. It also helps if the industry you go into has similar key success factors so that you already know how to leverage them. If the industry is at the similar stage of the industry life cycle, right? If you know how to turn around companies that are in a decline stage of industry development, you've done that successfully once, you'll probably do it successfully again. You've developed the know-how, you know how to do it, you have the people who know, who have the capabilities. So it'd be easy to replicate. And again, there are multiple dimensions on which businesses could be similar or related, strategically related. So if that's the case, even if it's not obvious to the rest of the market, then that is probably a good reason to consider diversification. And then the final part of our talk, right? So how do companies exactly pursue diversification? As I said previously, the one way is to simply create this new business from scratch, which is problematic for a number of reasons. It takes a lot of time to grow the business. You need specific capabilities. The market or the industry could be crowded. There could be entry barriers. So like all of those things. So most businesses, at least historically, when they consider diversification, they would consider doing it through merger and acquisitions. And we've talked about the managerial motives for merger and acquisition and how people are sometimes driven by the wrong incentives to force their companies to diversify, especially if it includes, international diversification. All of a sudden you feel you need to have a department in, I don't know, northern Italy, so that you can spend 3 weeks a year over there for the benefit of your shareholders. So, those are definitely valid. And if you are ever in a position to make a determination on the diversification or M&A strategy of your business, always keep that in mind. Be vigilant about it, whether or not this is what really drives the M&A efforts. There are definitely financial motives that can motivate companies to consider merger and acquisition. So you may try to acquire underperforming company because you know so much about the industry. You understand where the problems come from. The market may be skeptical about the company. You know better than the market, so you take it over, you flip it around, and you realize the benefits. There could be tax benefits associated with acquisition, so this is also a strong financial motive. I am somewhat skeptical about that in many cases, but taxation systems are definitely not universal around the world, and many companies are moving their headquarters around to put them in tax haven where they don't have to pay, anything similar to what they would pay in the United States. So, why not? As long as it's legal, definitely why not? And then sometimes you can acquire the company and change the capital structure of the target firm, reducing your cost of capital through that. So that will free up the money and make the money cheaper that you have available for investment in other potentially interesting projects. So that is definitely a financial motive for merger and acquisition. There are also strategic motives, right? So not the managerial, not financial, but purely strategic. So when you engage in horizontal acquisition, that is, you buy companies at the same stage of the value chain, you buy competitors, you do that to increase market power. And specifically, you increase your bargaining power against your buyers and suppliers, which means you can demand, you can keep a larger chunk of value created by your company. Otherwise, you'd be sharing it with suppliers and buyers. Now you have the power to demand more. Um, Sometimes you engage in merger and acquisition for the sake of geographical extension, especially international ones, because there are all those barriers to entry. So you circumvent it by simply buying a company in a third country. You may engage in vertical integration by merger and acquisition. So you buy a supplier or you buy a buyer, and then you continue supplying other companies downstream. And sometimes you buy a company to just diversify, to go into other industries, other businesses where hopefully there is some operational relatedness or strategic relatedness that would enable you to get the benefits associated with correctly implemented diversification. And acquisition typically brings about some benefits, although it does come with challenges as well. So increased market power, as I said, is a big one. Overcoming entry barriers, especially internationally, but also in terms of industry barriers. What is specifically important is that acquisition speeds up new product development and time to the market quite substantially. Right? So when you engage in the innovative project internally, you don't necessarily know what you're going to get. You've probably heard that a lot of innovations are purely accidental, right? And I believe I talked about that as well. You only know how much you're going to spend, not what you're going to get out of it. When you acquire a company that already has an interesting technology or that maybe has a prototype, you know exactly what you're getting. So uncertainty is out and speed to the market is much faster because you already know what you're dealing with, and that company has probably made some inroads with potential customers. So risk is much lower. Costs are potentially lower as well. It increases diversification, which safeguards you from some of the industry cycle dynamics. It helps you reshape your firm's competitive scope, again, potentially creating those opportunities for private synergies that would translate into benefits for the shareholders. And you also get to learn and develop new capabilities, not just from the target firm as such, but also through the process of incorporating the acquisition target into your business. So you remember we talked before about dynamic capabilities and how it is important for companies to develop this capability of coming up with new capabilities. So that's the issue of the same magnitude, of the same character. If you learn how to acquire and integrate the companies and structure them properly, that's definitely a capability you can reuse in the future. And if you have a competitive advantage here, a specific competency here, you can outperform your rivals when it comes to acquisitions and mergers in the future. At the same time, more than 50% of acquisition attempts fail to realize the benefits expected by industry analysts or by the acquisition targets. So in many ways, it is similar to marriage, right? You know that more than half of them do fail. Why is it the case? First of all, inadequate evaluation of target. And typically, actually, it's usually the target companies, shareholders who reap most benefits from acquisitions, almost never the acquiring firms. So why would an acquiring firm will not be able to provide an adequate evaluation of the target? Because it's done in a different industry that they do not necessarily have a good experience with or first-hand knowledge with. They don't know what to pay attention to. Not all of the information they can find is accurate, and not all the information critical for correct assessment of the company is available. So because of that, you make a mistake. You value the company much higher than it should be valued by the market. And this is why the target company is happy to be bought, right? So if the target is too happy, then probably it's a sign that something's not right. As a company, as an acquiring company, you may take on extraordinary debt to complete the acquisition, and then you have to service that debt. That may have a very negative implication for the bottom line. You may end up in a situation where you have too much diversification, right? So again, the cognitive limits of top managers, the bounded rationality probably would not allow you to manage the entire enterprise effectively. It's also very exciting for managers. You know, it's like a new toy. You bought a new business, you pay all your attention to that business, you stop really doing much with the rest of the company. So you neglect your other managerial responsibilities even if the integration is done well, because you didn't pay attention to the rest of the businesses, those could suffer some strategic losses. And at some point, the company could become too large, right? So I told you, General Electric, 27 layers of management. One of the reasons is that because it was so diversified, it had to have those, uh, structures on top and structures on top to manage that behemoth. And at some point, it eats up all the benefits that you create. So what else? Best practices, acquisition and best practices. And I have to relocate. My computer is about to die, so please bear with me. You definitely want to acquire companies that are related, to you, so you can get the synergies that the acquisition can provide. You want the acquisition to be friendly. So there are two kinds of acquisitions. We may talk about friendly acquisition or hostile takeover. The reason why you want it to be friendly is that hostile takeovers, they typically alienate key employees. So you buy the company because you want employees who have the know-how to work for you to provide those same benefits you were getting previously now for the merged combined company. But people get upset. When that happens, you actually get the worst possible situation. The best employees have left the company. The worst employees who have nowhere else to go are staying with you, and you cannot let them go because at least they know something about how that company is run, right? So you definitely do not want to purchase the company in a hostile manner because it will, well, you'll be shooting yourself in the foot. You definitely need to engage in due diligence. You try to learn as much as possible about the company. Again, if it looks too good to be true, it's probably not true. There's probably something you're not paying attention to. It helps if you have organizational, especially financial slack, so you don't borrow too much to finance the acquisition. And the other thing, again, this is something that we do not talk about typically, especially when your acquisition is motivated by developing some interesting technology or getting access to technology and speeding up new product development. When you buy another company as a source of technologies, it tends to kill your internal ability to come up with innovative products. And it doesn't take long for your internal R&D to lose their focus, to lose their ability to come up with great products or great technologies. When you finance the acquisition, you spend the money that could have gone to your internal research and development, you spend it on acquisition. So you rob Peter to pay Paul. People get disillusioned, the resources are not enough, your organizational capabilities shift away from internal R&D to managing this acquisition. It only takes about 2 years. So I've seen some research that proves that after 2 years, your internal research and development effectiveness goes down significantly. So I want to be very careful with respect to that. And so it turns out you don't have to necessarily acquire other companies to get the benefits of diversification or vertical integration or any of those other things that we've talked about previously. You can actually get almost the same benefits by simply collaborating with companies that already have positions in the industries or markets that you're interested in, right? So if your goal is to access partners' resources and capabilities rather than acquiring, like outright buying resources and capabilities, you can do that through strategic alliances, joint ventures, or multi-firm networks. right? You can simply partner up and not commit your financial resources to an uncertain project. When we talk about strategic alliances, there are two kinds: equity-based and non-equity-based. With equity-based, you and your partner, you sort of exchange some portion of your equity, and supposedly this aligns the incentives. That makes you, wish each other well and make sure that everybody's on the same page. With non-equity-based strategic alliances, even that is not necessary. You simply reach an understanding, you discuss how the proposed alliance benefits both parties, and you stay true to that agreement that you've signed. A lot of companies actually do that nowadays. So that trend shifts away from mergers and acquisitions towards those more flexible arrangements that allow you to maintain your independence, allow you to consider multiple partnerships as long as it benefits all the parties involved. So the Japanese car manufacturers, Toyota specifically, historically has been very strong and building those non-equity based alliances. They would ask you to make a transaction specific investment, which ordinarily you would be very hesitant to make because this gives them power over you, right? They can reduce the price they're going to pay for your outputs, and you will have nowhere else to go, so you'd have to accept that lower payment. So Toyota believes in looking after the interests of all the parties involved. So it engages in those non-equity based alliances, and they have done wonders. You may also try to create a joint venture with one or more partners. In this case, an independent company is set up that is jointly owned by the partners to the joint venture. Right, so in this case, the incentives are explicitly aligned. There's a company that now co-owned by you and one of the partner from a different industry, and it can leverage the technologies and capabilities that belong to both you and your partner for your joint benefit. So again, something that a lot of companies have started playing with lately very actively. And it doesn't have to be limited to just two partners. What you see now is multi-firm networks being created and leveraged across different industries. I gave you the example of those small and medium-sized networks in a Scandinavian context. In Denmark, I believe, over 30% of new firms are members of networks that work together on innovative projects. They develop new products, they market them together, they compete together against larger companies, and it seems to be working just fine. So these networks come in two basic forms. It could be stable or dynamic. With stable ones, you work with the same partners all the time, and this is very common for like fashion design industry in Italy. The dynamic network, this is where your partners shift as your needs shift, and that is very common for industries like information technology. And this collaboration provides multiple benefits to all the parties. The specific benefits will depend on the kind of market you're in: slow cycle, fast cycle, or standard cycle. So in a slow cycle market, the primary benefits would include access to a restricted market, or maybe market stability through establishing standards. Right? We talked previously about technological standards and dominant designs, so this is where it comes into play. In fast cycle market, the primary benefits would include new product development speed and market entry, the same thing that we've discussed previously with mergers and acquisition. It helps you maintain market leadership. It also helps you form technology standard. You share your risky R&D expenses with multiple parties, and you overcome uncertainty because the industry is largely comprised by multiple parties. As long as all of them agree to do something, they reduce this uncertainty for every party involved. And then in a standard cycle market, the benefits include primarily market power, right? You coordinate your activities. Think about airlines, all those alliances, flight share and whatnot. It increases your market power, provides access to complementary resources, economies of scale, trade barriers, all of those things, it turns out you can get without necessarily having to acquire a company in a different industry. So the benefits are many and the risks are not quite as significant. And that completes my today's presentation. So I hope you guys, hope you enjoyed it. I hope you've learned some lessons. If there's anything I could add, do not hesitate to contact me. I would be able to provide additional information on the topics that are of interest to you. And otherwise, we have just 1 week left of lectures, 1 exam and a few of the projects, and you're almost done. I'm very excited for you and for myself. So I'll see you next week.